Hello everyone, Guillaume Lusomé here, host of the E-Commerce Wizards podcast, where I feature leaders in e-commerce and business. If you're an e-commerce store owner, or if you're involved in the finances of an e-commerce store, this episode is for you. Today's guest, Matt, is a CFO, a Chief Financial Officer, specialized in e-commerce. So he has all kinds of techniques, optimization tricks that he can teach you to improve the company's finance, make the entrepreneur more wealthy, more successful, just make situation more pleasant to be in by optimizing cash flow, cash conversion cycles, by improving how we structure financial deals and so on. This is a very interesting episode if you're in the finance or entrepreneurship space for an e-commerce store. Today's guest is Matt Putra. He's the founder of the company EightX. He's a fractional CFO. So that's a chief financial officer for hire that you can have part-time working with your company to improve your company's situation. So today's very interesting topic, financing structure for e-commerce store owners. So you're looking to improve the finance of the company, learn some techniques, some ideal deal structure, and so on. This episode is for you. All right, Matt, thanks for being here today.
Thanks for having me.
Well, my pleasure. And so you're an expert in e-commerce and you're a CFO, so you're an expert in finance and e-commerce. Tell us a little bit about yourself very briefly, and then we jump into the main topic.
You got it. So I was the CFO for a number of years of a private equity group. We did about 500 million in projects, and that's where I learned, obviously, to run finance, audit, tax, everything, planning. Now we work with 20 clients around the world, US, UK, Canada, Austria, Australia, and we help them run their businesses, scale their businesses with more cash and less stress.
Pretty awesome. I like that. Great value proposition right there. All right. So for a main topic, ideal financial structure for e-commerce store owners. So I'll let you lead.
You got it. So when you think of financing your e-commerce business, there's so many options: Shopify, ClearCo, Wayflyer. What is the best way to put all these things together? What's the best way to manage risk, to have better cash flow, and just to have the capital that you need available? So I want to cover a few things. Most of you're going to have inventory, you might have accounts receivable, you might have prepaid expenses, and then you have your accounts payable, you have credit cards, you have wages payable, sales taxes payable. So when you take the assets, inventory, AR, you deduct those liabilities, AP, credit cards, that number is called your working capital. Your working capital, you'll find, has a relatively stable balance over the course of time. A lot of people, for a company doing, let's say, 5 million a year, your working capital ideally would be around 500,000 to 700,000 every month. It's going to be in and around that number, fluctuating a little bit. Now, the way you finance this is what I like you to do, is to finance about 80% of that number, the base number, the average over a 12-month time period. Finance 80% of that number with a term loan. Now, why? You could finance it with Shopify Capital or ClearCo, but the trouble is that when you do that, you have to pay those back so quickly that you're sucking cash out of the business that you could otherwise put back into growth. And what you're trying to do is match the time frame of the loan with the time frame of the asset that you're using it for. So if I look at your working capital, current assets minus current liabilities, because it's a stable number, what I want you to do is get a long-term loan. You don't want to pay the loan back in 6 months because that number stays on your balance sheet all year round. So the best case is to get a 3 to 5 year loan for 80% of that working capital balance. You'll have very low payments. You'll have a good chunk of money coming in the door. The interest rates are quite good. Now, what you give up, of course, are personal guarantees and some of those types of things. But when your business has been doing 7 figures a few years in a row, these kinds of loans are all loans at risk, but they're not that risky. Your business is going to just dry up overnight for most people anyway. So when that's the ideal, is to finance the working capital. We call it the working capital base. Finance about 80% of that with a term loan. The balance of the 20 should be funded by operations. Now, that's ideal. What if your credit score isn't good, or you had losses last year, or things of that nature? What can you do? Well, still go and look for a term loan. One great person in this space is called Sellers Funding. They will give you 12 to 18-month term loans. Now, it's not as long as you'd like, but it's still a longer term loan. And the reason I want a longer term loan is just because to manage the payment outflow. If you were to take your working capital base and finance it with Shopify, you can imagine what having to pay back 500 grand in 6 months feels like. It's really not nice. If you finance it with Sellers Funding, you pay 500K back over 18 months, which is infinitely better for cash flow, which means you are creating a whole bunch of extra cash that you can put back into the growth of your company instead of just paying off the lender. Now, that's your working capital base. Okay, we have option one is 5-year term. Option two is somebody like Sellers Funding who can do 18 months or so. Now, what about the seasonal spikes in your assets? So, a lot of us, we need to pay for inventory 6 months at a time. So you'll have a big spike, and then you'll start to draw down and it'll normalize. How do we finance the spikes? Well, those are great opportunities to use Shopify, ClearCo, Wayflyer, PayPal Capital is actually one of the really great one. If you have PayPal Capital offers in your account, take that one. Very low interest rate and great payment terms compared to some of those other ones. But because the spikes only last for a short time, you can match them with a shorter term financing. So if you have a massive inventory buy, 4 months of inventory, it's coming on the boat, you can grab Wayflyer. You'll pay the Wayflyer back over 6 months. But by the time that 6 months is done, you will have also gone back to your normalized working capital base. So you see how I'm matching the timeline of my need with the timeline of my capital. And in that way, you have your longer term loan, you have a small Wayflyer piece or ClearCo, Shopify, whatever, and you're matching the timelines with the timeline of the debt. When you do that, you optimize for risk as well. Here's why. If you finance your whole working capital base with Shopify, let's say, you have to pay the whole thing back in 6 months. You haven't sold all the inventory by the end of 6 months. So what does it mean? You're sucking money out of growth. You're sucking money that you could otherwise hire more help.
And out of that 6 months, you might actually have 3 months of inventory on the water before it arrives back to you.
Exactly. So you're paying stuff down when you're not even selling it. You're taking money out of R&D, CRO, SEO, stuff that Guillaume could do with design. You're taking money out of core growth functions of the business when you don't match the timeframes. Why is it at risk? Well, when you suck money out of growth, you haven't sold it. Well, if you can't keep growing because you don't have the money, well, what does that do to your business? Well, I've seen businesses get into a cycle where they have to keep pulling money out of growth, and they're like, their new customers drop, and their repeat customers, you're not filling the repeat customer bucket as fast as it's churning. So your repeat, and so it's a slow kind of downward movement. And so one of my first things that I do with any company is review their financing structure. And the first thing that I want to do is match the timeline of their working capital with the timeline of the financing. And it just unlocks cash, unlocks growth. The other thing, just is qualitative, is 6 months paybacks is so stressful. You take the money and you're like, I have to reserve all of it because I have to pay it all back in 6 months. So you don't really end up using it properly. And it's hard to sleep when you got this talk. The clock is ticking. But if you use Shopify for the short-term bump, it's fine. You're just using it for a short time, pay it off. It's fine. You've already sold a bunch of inventory. It works out. Then you have like very large spikes sometimes. And those ones, you can use any of these lenders for. You can use your credit card sometimes. You can use your line of credit. You can use, ClearCo. And again, those very short term, like large, like let's say you have to, you pay your 30% deposit for something coming from across the ocean, and then there's a 70% payment before they ship. So that's a very large spike. So that's a really great one to use Shopify ClearCo, because you're going to pay and it's going to be here in a month. You're going to start selling and you're going to start paying at the same time. So that's a good one. Another great option for folks that have a hard time accessing credit is Kick Further. For those of us in the United States, Kick Further has a wonderful way that they structure their financing in which, and the interest rate's high, but you get a piece of credit, you don't start paying until your stuff lands in your warehouse or 3PL. And that's when you kick in the payments. So their structure is really great. It's expensive, but the payment terms are really fantastic.
This episode is brought to you by MageMontreal. If a business wants a powerful e-commerce online store that will increase their sales, or to move piled up inventory to free up cash reserves, or to automate business processes to reduce human processing errors, our company, MageMontreal, can do that. We've been helping e-commerce stores for over a decade. Here's the catch. We're specialized and only work on the Adobe Magento e-commerce platform, also known as Adobe Commerce. We're among only a handful of certified companies in Canada. We do everything Magento related. If you know someone who needs design, support, training, maintenance, or a new e-commerce website, email our team at support@magemontreal.com or go to magemontreal.com. That's MAGE Montreal.com.
Okay, and you mentioned the use of a line of credit. Any recommendation for e-commerce merchants around that?
So everybody should have a line of credit.
Agreed.
Everybody should have a line of credit. Line of credits, when I said the base is a term loan and the bumps are you can use Shopify for. I mean, if you have a line of credit, you can use the line of credit for the bumps. Here's why. When you use line of credit, we all know you can pay for the 100 grand to manage that bump, and you don't actually have to pay it all back until you sell what came in the bump, basically. So that's actually a better solution than what I said before. One thing for people to know is that most banks want you to have large lines of credits and lower term loans. There's a very specific reason for that. If you have a line of credit with a bank and they notice there's a problem in the business or the economy, they can begin to restrict your use of the line of credit. If they give you a term loan, you have the money, and as long as you don't violate the terms of your agreement, they can't do anything about it. But if it's a line of credit, and let's say for some reason your business has a loss or the economy has a problem, the bank can restrict your line of credit. And let's say you had a 400 grand line. Let's say you make a loss. They can say, okay, you do not have access to this anymore. We're going to turn this into a term loan. And then they take away that liquidity. So when your bank suggests financing your whole line of credit with a term loan, tell them, no, I want this much in a term loan. Or if your bank says to finance it all with line of credit, tell them no.
Yeah, exactly.
Yeah, sorry. Yeah, I said it the wrong way. But so don't do everything with a line of credit. The banks do it because A, they make more money, B, they can restrict your access to funds. So don't do it.
Yeah, line of credit is sort of a blessing to grow the company, because sometimes you need that. It allows you to smoothen the growth. But like you said, it is a risk to manage because they can cut at any time. It's not money in your pocket. It's like they could revoke or reduce the amount that you have any time. So nope, we're cutting $500,000 out of it. It's like,
exactly. Yeah, it's called a demand loan for that reason. At any time, for almost any reason, the bank can just restrict it. It's called a demand loan, and most banks don't do this, but technically they're allowed to demand it back.
Yeah, that's and you have to check also the terms of your loan, even the 3-5 years loan we're talking about, if they can recall it or not, and if that bank ever did that before. It's not like it's going to be advertised on the internet, but sometimes you can sort of know. So there are a few commercial bank, US, Canada, that have done that in the past. If you do your research, I don't necessarily want to throw out names, but I'll say a name of one that does not do that. It's very good in Canada. It's the BDC, the Development Bank of Canada.
Yes,
they never call back loans. They're there to support you. The rest, it's a tiny bit higher, not that much, a point or two, but they're there for you, and they're not going to ever put your business in trouble by calling it back.
Exactly. And in fact, you'll find a lot of the big banks will work with the BDC for Canada, SBA for the US. When a big bank has a client with trouble, sometimes they'll ask BDC to take over the loan, and you'll just move over to BDC just because BDC knows how to help people through that stuff.
Didn't know about that. I know they often share the loan with if BDC comes in, then the banker says, okay, I'll take half, because they don't want more than half of the risk, let's say, but they do want to lend you money because they make money. So they need customers, just like you do. You need customers, and
exactly.
You just happen to lend money to find customers. Very good info.
Thank you. Yeah, and I mean, I follow my own advice too. So just this year, we're all looking at 2023, going, "Hey, this might be a tough year." And before things things aren't tough, but before things got tough, I went to my bank and said, "Hey, can I have a term loan for this amount of money for our own working capital, for some of our growth initiatives?" So I have a term loan, and I have a line of credit, and I have some credit cards, and I've layered them all in the amounts that I think are appropriate for myself. And the most important part about that was I did it long before I needed any money. And that's what I want to
Yes,
say to the listeners is that if you don't need money today, great. This is when you should go get money,
absolutely. When,
right?
yeah, because you have to show strong financial posture, then
Exactly.
you're a low risk uh, person to lend to or business to lend to. If you
100%.
wait to need money, they will either not give it to you or give you a higher interest.
Exactly.
It's going to cost you
Yeah.
more. It's like even then just taking it in advance and just sitting on it more or less, or putting it
Yeah. I
in
mean,
a very safe place in the
yeah,
meantime. And
I may never even use this term loan that I got. I might just pay it off next year when the economy recovers and everything's,
yeah,
gravy. I might just pay it off. And
yeah,
the cost to me will have been a year's worth of interest, which is insurance, in my view. If anything happens with the economy, our business is covered we have probably 16 months uh, of operating expenses. And it's just insurance. I won't always do that in every year, but in a year where the economy looks tough, to have
yeah.
12, 16 months of operating expenses it's a competitive advantage. I can take risks still in a tough year because I have the reserve.
Agreed. It has to be seen like a tool, like you're buying insurance or you're
Yes,
buying another tool. Like I
exactly.
have this tool in my toolkit. I have access to X amount of capital that I can deploy. I can start a new
Mm-hmm.
project. Like this year, AI is all the rage now. Like,
Yes,
oh, Chat GPT, OpenAI,
yes,
blah, blah, blah. It's exploding everywhere. Well, if you don't have any dry powder, as sometimes they call it, reserve cash, well, you cannot do
exactly.
anything. You know?
100%. 100, and
So
yeah, 100%. And the sleeping at night factor is huge. Is like I really don't have to worry much about a shock to the economy because I have the reserve. Like right,
yeah,
like I
yeah.
sleep like a baby. You know.
Yeah, agreed with that. Excellent advice.
Mhm.
Anything else that you'd like to share with the e-commerce store owners for their finances?
Yeah, I would say one of the things people can do when you approach lenders, I want you to look smart, and we don't always have to know what we're doing, but we just need to appear like we know what we're doing. When one key way to do that is to have what's called a data room. So what you're going to do is create a Google Drive folder, and you're going to have 4 or 5 folders: corporate, financials, APAR inventory, and like sales, let's say. And in each folder, you're going to put relevant documents. So in the corporate folder, you're going to have your certificate of incorporation or your founding constating documents, share registers, corporate articles, all the boring shit. In financials, you'll have 2 prior years of your accountant financials. You have your interim statements from this year. APR inventory, just have your inventory report, AR, AP, and then sales and marketing is where you can put things like a deck or some relevant statistics about how your company functions. We have a really high retention rate, or we have a great AOV to CAC, or you can put some of those things in there. And when a lender says, "Hey, you have your info?" And you go, "Yeah, no problem." And 5 seconds after the call, you send them a link to your data room. You just look like you know what you're doing. And when you look like you know what you're doing, you give the investor or the funder confidence. When you give them confidence, they see it as an easy way to make a commission, right? And all these people work on commission. And so if they know that they can take your company to their credit committee and it's an easy pass through, they'll give you the time, right? And giving them confidence is the whole thing. And when you give them confidence, you can negotiate for less interest as well. So that's the last thing I'd say about that.
Awesome, Matt. Well, thank you very much for being here today. If somebody wants to get in touch with you, what's the best way?
You can check out my website, www.eightx.co, EIGHTX.co. LinkedIn, you look up Matt Putra, MattPutra. I'm on LinkedIn all the time. You're welcome to pop a message, ask me some questions, whatever you like. I often respond to people's questions or comments on my stuff.
Awesome. Thank you, Matt.
Thank you, Guillaume.